Hi everyone. Today we're going to build a crypto CFD trading strategy based on a famous concept, the Triple EMA. So what is a Triple EMA? It's a trend following method that uses 3 exponential moving averages of different periods to identify and confirm market trends. This approach significantly reduces false signals compared to a simple 2 EMA system. The core setup relies on a fast, medium, and slow EMA. While there are many configurations we could optimize later, for short to medium-term trading, we will use periods of 9, 21, and 55. Here is how the signals work. Buy signal, generated when the fast EMA 9 crosses above the medium EMA 21, and the medium EMA is already above the slow EMA, is already above the slow EMA 55. Essentially, 9 greater than 21 greater than 55. Sell signal, the vice versa. When the fast EMA 9 is below the medium EMA 21 and the medium EMA is below the slow EMA 55, essentially 9 less than 21 less than 55. Before we dive into the code, let's review this visually on TradingView. If you're on the free version of TradingView, you might look for a triple EMA indicator, but you'll often find it only plots one line. That doesn't help us. We need 3 distinct lines. Normally, the free version limits you to 2 indicators, forcing you to upgrade to get a third. But here's the power of coding. I've already built a custom Triple EMA script. I'll drop the code in my GitHub for you. As you can see on my chart, the blue line is the EMA 9, the orange line is the EMA 9, the red line is the EMA 21, the red line is the EMA 50. Note, we used 55 in the logic, but visually here it's mapped to 50 for demonstration. Now, the big question: is this strategy actually profitable? If you look at the chart manually, it appears very profitable. Let's look at the last buy signal. The EMAs crossed over at this specific point. The blue line 9 moved above the orange 21, which was above the red 50. Here's a short signal. The 9 dropped below the 21, and the 21 dropped below the 50. It looks clean, right? But appearance isn't evidence. Do we have statistical significance? Do we have proof that this works live? Manual backtesting has serious traps. Trap number 1, the ghost bars. Intra-bar versus closed bar. When you look at a closed candle, you see the final price. But during the formation of that candle, especially on a 1-minute time frame, the price might have dipped below your stop loss before pulling back to close above the EMA. In manual backtesting, you only see the close. You think, great, my SL wasn't hit. But in live trading, that intra-bar dip would have stopped you out. This is a classic illusion that makes strategies look better than they are. Trap number 2, unknown real risk reward. Manual backtesting rarely gives you accurate win rates or risk-reward ratios. Look at these recent trades. One has a 1 to 6 reward, another 1 to 2.5, another 1 to 6, then 1 to 1.32, then 1 to 1. You don't know your average real risk reward. You might think, my last few trades had a 1 to 3 ratio, so my strategy is a 1 to 3 strategy. But if the reality is that your average is 1 to 1.5, that small detail could make your entire strategy unprofitable. This is why we code. Coding allows us to run hundreds of trades to find the actual statistical edge. However, when we code, we must ensure our backtest is free from look-ahead bias. For example, on a 1-minute candle, I can only know the RSI of the current closed candle, for example 49. I cannot know the RSI of the next candle before it closes. Using future data creates a fake edge. Trap number 3, ignoring costs. A strategy might look profitable on paper, but does it survive real-world costs? For Bitcoin CFDs, these costs include spread. On a $10K account with 1 to 5 leverage, a 20 pip spread could cost you $100 on entry and another $100 on exit. Swap or funding, holding overnight might cost you $25. Result: if you lose a trade, you're not just down the trade loss, you're starting with a negative $25 deficit due to spreads and swaps. Slippage: this is probabilistic, not predictable. Calm market, $1 to $3 slippage. Normal, $3 to $8. Volatile, $8 to $20. Extreme or low liquidity, $20 to $50 plus. Market open or close, $5 to $15. Let's do the math. If you win $15 on a trade, but pay $10 in spread and slippage, your net profit is only $5. If you lose $15, your real loss is $25 plus. These costs eat away at your edge. The solution? Automated backtesting with costs. This is why you must move from manual to algo trading. We will include every cost spread, commission, funding, and slippage in our backtest. Interestingly, when we factor these costs in, this specific Triple EMA strategy becomes profitable if we push the risk-reward ratio to 1 to 3. With high costs and a 1 to 2 RR, it's unprofitable. With optimized ECN accounts and 1 to 2 RR, it might break even, but it's risky. With a 1 to 3 RR, it becomes consistently profitable. But here's the catch: should you force every strategy to have a 1 to 3 RR? The reason this specific strategy works at 1 to 3 is that I've backtested it over 2 years of data. I have the statistical significance to prove it holds up. Even then, there is still an issue visible in the equity curve that might make it unsuitable for some traders. I'm sure some of you can already spot it. In the next video, we will code, optimize, and validate this strategy step by step. We'll go from loading the data to running the final backtest that proves why the 1 to 3 RR is necessary. If you found this useful, please subscribe and share it with your friends. Remember, you don't need to lose money to learn. Trade systematically, verify everything, and I'll see you in the next video.